Ladies and gentlemen, friends, investors, we stand this week at what may be one of those rare inflection moments, one of those weeks where what was believed to be steady begins to become fragile, where what was assumed safe begins showing cracks. In all my years of observing cycles, macro, debt, asset, geopolitical, I have learned this. The world does not change in slow motion. Sometimes it pivots in what feels like a week. And this week may well have changed everything for those who have trusted gold and silver as their ultimate safe havens. Because today I want to ask you, is it still time to hold gold and silver? In markets and in life, what most people miss is that almost everything moves in cycles. Debt rises and then it falls. Economies expand and then they contract. Currencies strengthen and then they weaken. These cycles are as old as recorded history, and yet when we're in the middle of one, it always feels like it's different this time. That's one of the biggest mistakes investors make. They get caught up in the moment and lose sight of the bigger pattern that is playing out. The truth is that the same fundamental forces repeat again and again, just in slightly different forms. And the key to navigating them is to recognize where we are in the cycle and what is likely to come next. An inflection point is the moment where the trajectory changes. It doesn't usually announce itself clearly in real time. Instead, you see signs, subtle at first, like a shift in credit conditions, changes in liquidity, or the tone of policy makers. Then, suddenly, what looked like a smooth continuation turns into a sharp bend. Investors often confuse stability with permanence, believing that because something has been true for years, it will always be true. But history shows the opposite. Stability breeds complacency. Complacency encourages risk-taking, and excessive risk-taking eventually leads to instability. It is precisely when people feel most comfortable that the seeds of the next downturn are sown. Think about how debt cycles work. Credit expands, optimism rises, and leverage builds. Asset prices climb, supported less by fundamentals and more by the easy availability of money. Eventually, the cost of servicing that debt increases, cash flows are squeezed, and the system becomes fragile. The turn usually happens faster than most expect. People are always surprised by how quickly confidence can shift. A single week, a policy announcement, a surprising data release. These can serve as the spark that reveals underlying weakness and shifts the trajectory. These inflection points are not random. They're the result of imbalances that have been building quietly. When interest rates move higher than the debtors can bear, when inflation rises faster than policymakers are comfortable with, or when global tensions force capital to move differently, the cycle responds. What felt like a tailwind turns into a headwind. These are the moments when investors who have been lulled into complacency find themselves unprepared. The perception that certain assets are guaranteed safe havens comes into question, and portfolios built on yesterday's assumptions suddenly look fragile. The way to handle this reality isn't to predict every small twist and turn. Nobody can do that consistently. The key is to develop a framework that recognizes the patterns, understands the mechanics, and accepts that human behavior is the driver behind them. Fear and greed don't change. They simply express themselves in new environments. Each generation thinks they are smarter than the last, but cycles remind us that human nature hasn't evolved as much as we like to think. The environment shifts, the technologies are different, but the rhythm of excess and correction remains the same. For investors, the challenge is to remain balanced at a time when balance feels unnecessary. It requires the discipline to look past the noise of the moment and ask, are we closer to the top or the bottom of this cycle? Are we approaching an inflection point? It also requires humility, the willingness to acknowledge that our own instincts are usually shaped by recent experience, which makes us blind to the next reversal. When things are booming, it feels unnatural to prepare for contraction. When things are collapsing, it feels unnatural to buy. Yet those are exactly the behaviors that cycles reward. Understanding cycles and watching for inflection points is less about timing the exact day and more about positioning yourself so you're not caught off guard. If you accept that cycles are inevitable, you can build strategies that are resilient, that survive both the upswings and the downturns. The inflection point is not just a moment of risk, it's also a moment of opportunity. Those who see it coming and adapt can preserve wealth and sometimes even expand it, while those who ignore it usually pay the cost of denial. When you look across history, you see that every form of money carries with it both strengths and weaknesses. Some forms are hard, meaning they cannot be created easily and are not someone else's liability. Others are soft, meaning they can be produced at will, are tied to credit, and ultimately rely on promises that may or may not be kept. The distinction matters because in times of stress, people migrate toward whatever they believe will hold its value when everything else feels uncertain. That's why civilizations across thousands of years, from Rome to China to modern economies, have cycled between trust in soft money, created by governments, and the safety of harder forms that cannot be debased as easily. Hard money has always appealed to those who worry about excess. Gold, silver, and other scarce assets cannot be printed. They have to be mined, stored, and transferred physically. This makes them reliable in the sense that they're not dependent on political decisions or central bank balance sheets, but they are also inconvenient. They don't generate income, and their price can fluctuate as confidence shifts or as interest rates rise and fall. They serve as a store of value across centuries, but in any given year they can disappoint those expecting stability. That's part of the paradox. Hard money provides durability over the long term, yet in the short term it can behave like any other asset, rising when fear is high, falling when confidence returns. Soft money, by contrast, is flexible. It allows economies to expand, credit to grow, and governments to finance wars, infrastructure, and welfare. It can lubricate commerce in ways hard money never could, but with that flexibility comes risk. Because it is someone else's liability, it depends on trust. When that trust erodes, when inflation rises, when deficits balloon, when confidence in leadership declines, soft money can lose value quickly. What seemed like stability turns out to have been an illusion built on faith in promises, and when those promises can no longer be sustained, people scramble for harder alternatives. The healthiest way to think about this is not to idolize one form of money or demonize another, but to understand their roles and their cycles. Soft money dominates in times of expansion and optimism. Hard money regains relevance in times of contraction and doubt. The pendulum swings back and forth depending on where we are in the broader economic and political arc. No single form of money has ever remained dominant forever. Empires have risen with their currencies, only to decline as their fiscal and monetary excesses eroded trust. Hard assets often step in to anchor the system when the credit